New Zealand's housing market has gone from feast to famine faster than a V8 running out of petrol. Construction's collapsing, residential buildings at 10-year lows, and yet, somehow, everyone's still wondering if it's a good time to buy. Spoiler alert, when the pipeline dries up, prices don't politely stabilise. We've dragged in ASB's chief economist Nick Tuffley to explain why this points to the next property boom. He's next.
Financial freedom faster. Financial freedom faster.
Before we start, Mortgage HQ's snapshot has helped thousands of Kiwis stop renting, start investing, and see the game clearly. If you want the same clarity, it's waiting in the description below. Nick, if construction has hit the wall and supplies at rock bottom, are we basically lighting the fuse for the next housing price rocket?
Well, I think we're trying to light a fuse at the moment. It's one of those ones that Wile E. Coyote would be trying to light where it's pretty wet, not burning very effectively. We're still looking like we're going to have a fair amount of supply for a little while longer. So the number of listings when we look around the country and at Auckland is still very high. So we're still at like 10-year highs. And it's been creeping up. And the issue we've got at the moment is that the rate of sales is not keeping pace with the number of new listings coming onto the market. So we've seen the amount of stock available go up. Now, that's what's existing and available. Yes, we have seen construction drop quite a bit. We're down, sort of getting on towards a third from the peak. It does look like it may be sort of stabilising, bouncing around the bottom, but it's still at a reasonably high level. So we haven't seen the same sort of pullback that we saw during that global financial crisis. So we're still building at a reasonable clip at the moment. And that's going to keep bringing a degree of supply on. So, look, I'm pretty cautious about the notion that we might suddenly light a tinderbox and suddenly see an explosion in house prices. Because I think what we've got to remember is you've still got a lot of stock to chew through on the market. The building level has come down quite a bit, but it's still fairly reasonable. And also, we've got to put in the back of our minds that when we're looking at some of the other key drivers of the housing market, which is population growth, look, that has slowed quite a lot. The net migration flows are back to around about 10, 15,000 a year net basis at the moment. So we're not getting that population pressure that we were a couple of years ago. But having said that, just to quote Yaz, a sort of famous economist, the only way is up. And that is sort of what we think for prices. But it's looking like that recovery is stretching a bit into next year. We're still sort of flatlining a bit when it comes to house prices in the short term.
I'm impressed that we're keeping Yaz relevant in 2025. I don't think anyone in our viewers probably knows who she is, but I do. But she only had one good song. How on earth do you remember that song?
I don't know. It's one of those things that just sticks in your mind, doesn't it? A good one to sort of roll out in times like these, and just remember that what goes down must come up eventually too. So that will be what it is for prices, but we just need to be a bit patient.
Nick, is the OCR cuts pouring cheap fuel on the fire?
Well, they're helping give a little bit of extra fuel on the fire, but look, not too much. I think what we've got to bear in mind is that, yes, we've seen interest rates fall a long way. So the cash rate is down sort of 2.5 percentage points now. Fixed mortgage rates have gone from, say, being in a range of 7 to 7.5 to a range of, sort of like 4.75 to a bit over 5 around there. So they have dropped substantially. But we're looking about, is this like a not too hot, not too cold kind of interest rate? That's probably about where it is sitting. So it's not spectacularly low again. But it has certainly come off those highs. It's certainly eased the financial pressure on people, but it's probably not around that level where you'd say it's an absolute bargain. When you go back to between now and the post-financial crisis period, interest rates are sitting at levels which are a bit higher than what we've seen over most of that period. So yes, they're low compared to where they were, but they're not at that sort of screaming bargain. If I don't rush out and borrow money from the bank right now, I'm missing out on my biggest opportunity in life.
Building consents are barely a shadow of the 2021 highs. Are we looking at an actual shortage crisis, or is just too much drama out there?
I don't think we're going to run into a shortage crisis where we overshoot the other way and constructions end up being too low. I think what we've got to remember is that where the level of construction activity and consent activity was incredibly high and just driven by that absolute sort of artificial boom that we had during that COVID period and the immediate post-COVID period. So we did need to see some sort of settling back. When you look at the level of consents, level of building activity at the moment, look, it's not particularly low, but it has come back, I think, to better match that population growth story. So I don't think we're seeing the sort of population growth coming through over the next year or two that is likely to suddenly mean that we end up with this chronic shortfall of housing like we did for probably about 15 years leading up to that sort of COVID period. So things have come a bit more back into balance. We do need construction to be a little bit more not too hot, not too cold. The challenge always with construction and with the housing market is often that you do have quite a cycle in it, and that has been the headache for both the housing market and the construction sector. It really has been, as you talked before, about that sort of feast to famine kind of shift around that we've seen. We've gone from a pretty extreme time to quite a sharp fallback, but still maintaining like a reasonably decent level of construction activity. But it's just that if you've seen your activity, fall by 30% or so, it really feels like you've hit a brick wall.
Let's be blunt. Is this a once in a decade chance for first home buyers to actually enter the housing market at affordable prices?
Look, I think it is that the only thing that's really not screaming out for affordability is if interest rates were a lot lower. But let's put it in context for buyers. You've seen prices retrace, on average about 16% from the highs. That was a very inflated high, but it's probably about as low as we're going to see prices go in the foreseeable future. So that sort of pulled back prices from being extremely unaffordable to being a bit more affordable. Also, just remember over that time as house prices have come down, incomes have still grown. So there is actually still more affordability from the point of view that people can afford to pay a higher mortgage, a higher price than what they could several years ago. So on that front, big tick for affordability. And look, interest rates, probably more on that neither not too hot, not too cold sort of level. They're not a screaming bargain, but it has made it much, much easier to afford a house. And the other thing that's really important to remember is it's not also just about where mortgage rates are. It's also about where bank test rates are for when they are going through and doing the assessment of, can you afford this mortgage with a decent, safety buffer in there if things go rough. And to just put in perspective, when we had mortgage rates at the absolute low, you still had test rates around about 6.5%. That got up well above 9% at the peak of mortgage rates. We're now down below 7%. In the case of ASB, we're probably only about 40 basis points higher than what we were during those lows. So how much banks feel is safe to lend you, taking good care of you and lending in a responsible way, the assessments at which the banks are doing those, the interest rate at which they're doing those, is not that far above where it was during those lows. So that does really sort of open up that market. If you're someone who's got relatively low deposits, so you're needing to borrow a relatively high proportion of your purchase price, and that's basically your first home buyer situation right there. Your ability to borrow has strengthened quite considerably this year. So look, all up, lots of stock. You're not having to compete too hard. It's not like the Stampede where you need to dress up like Travis Kelce with all your sort of like headgear and padding on to go to the open home. You're not in physical danger anymore when you go in there. So you can take your time. You can be choosy. And from a financial point of view, probably the best conditions that we've had for some time. So yeah.
Okay, well, let's have a look specifically at Auckland, which is supposed to be the engine room of the New Zealand housing market. Is it more like a clapped out Corolla in third gear at the moment?
Well, I think it's a bit like the old Holden HQ where someone put too much diesel on the road and they're not really getting much traction out west at the moment. Look, it is being slow to get going, and I think there's a few things we need to remember about Auckland, which are quite relevant at the moment. Yes, house prices are generally high, high relative to income, so that sort of never helps. There is certainly that relief with mortgage rates coming down. But the other thing to think about with migration and its role there is that Auckland's population growth tends to be very fast when you've got very strong migration, because it does tend to have a disproportionate number of new migrants settle in Auckland. Now, we have seen those inbound migrant numbers sort of fall back. They're still high, but they have fallen back quite a bit. And we're also losing a lot of people as well, and that'll be from around the country. So I think we've got to bear in mind that sort of migration impact on Auckland and driving its population growth will be relatively muted. And just in general, that we are seeing it is the bigger cities that are being slow to pick up. And I think that's also reflective of, what are the fundamental drivers that are happening in cities at the moment? Well, it's really more around people going out and spending more money now that the mortgage rate has come down. And we're still in the very early stages of seeing that come through. Whereas provincial New Zealand, where you're getting pick up and export earnings, places like Queenstown around Wanaka, you've had a strong recovery in tourism, so they are booming in their own right, and they've got some drivers which are kicking in a bit earlier. Whereas Auckland and particularly Wellington, just slower to pick up.
Nick, it's always good talking to you. We always appreciate you coming on the show. Where can we see your reports on the ASB website?
Well, the best way to find them is to just go into the search bit and then type in economic insights, and that should send you to a page which will get you there. So have a dig around. We've got lots of reports there, and you can sign up to get them directly to your inbox.
Nick Tuffley, ASB Chief Economist, thank you for your time. Before we go, you don't want motivation, you want ammunition, moves that work, tactics that win. The 3 property formula is the playbook that smart Kiwis are already using while the rest are still refreshing Trade Me and panicking at interest rates. No fluff, no webinars, no BS, just results from the front lines. Written by old mate Andrew Malcolm. Get the strategy, own the edge. Grab the book before someone else buys your future.